Hey everybody, Chris Engelbert with Engelbert Financial Advisors in Allentown, Pennsylvania. And guess what? It is October 2024 and the fall foliage is upon us. But what are we doing today? We're doing our first of the month update. And we always start out with a cartoon. What's on every investor's mind right now? We got triple trouble. So it's like that kid in school who can't stay still, can't keep quiet. He's always getting into trouble throwing paper airplanes, etc. Everybody is worried about the elections, war, and obviously weather. And our hearts do go out to the people in North Carolina. We hope that gets resolved as quickly as possible. But let's talk about what's going on in the markets. And, unbelievably, you would think with the fact that there's literally fighting in the Middle East with hundreds of ballistic missiles flying overhead, etc., that you would think that the S&P 500 would show some kind of pullback. Well, it finished on a high note at the end of September and has literally climbed a wall of worry, obviously with all the things that are going on out there right now, and has obviously made a new high at the end of September. But one of the points that we've been making is that we are beginning to see a rotation. I call it a return to normal. And if you watch our Trade Talks video that we sent out, or if you download my app, you can watch our Trade Talks video. It was a 20-minute discussion, and I talked about what I call the return to normal. What I mean by that is that we believe that the stock market is returning to normal by the fact that it's not just being led by the Magnificent Seven, a small group of stocks. We're also seeing a rotation out of tech, and you can see that the NASDAQ is still lagging the S&P 500 and especially the Dow Jones Industrial Average. We think that this is going to be a theme going into 2025 where dividend stocks and value stocks are going to come back into vogue along with small mid-cap stocks as well. Let's talk a little bit about interest rates and what's going on. Obviously, the Fed lowered by 50 basis points short-term interest rates. That's literally the only place that they can control interest rates. But the cue for longer-term interest rates gets off of obviously what's going on in Fed funds. Now, bank CDs and treasuries in the 3-month area are still paying 4.8 to 4.85 as of this video. Eventually, where Fed funds is supposed to go is down to 3.5% by possibly next spring. Now, there's a lot of controversy surrounding about that because a lot of the models are showing that short-term interest rates should be substantially lower. We don't see that. We think that with the strength in the economy and the potential reboot of inflation, especially due to the shortages possibly caused by the dock worker strike, we believe that short-term rates are still going to stay higher for longer, but we're concerned about long-term rates. So you see from this chart that the 10-year Treasury bottomed right around 3.6%. Obviously, when the Fed cut the Fed funds rate on the short end, but you can see that long rates are beginning to float back up. Now, if you've been watching my videos all year long, I've been talking about lengthening your duration, buying longer term bonds, but you've got to be careful when you do this. So I believe that there could be a quick backup to around 4% on the 10-year Treasury. I think that's going to be a good opportunity to lengthen your duration and buy some longer term bonds at that point. I say you got to be careful because everybody out there is saying, well, if short rates are going to go down, we should just buy long term bonds now. You got to be careful because if inflation comes back due to some supply chain issues, you could see longer-term interest rates back up rather quickly. So let's sum it up. This is going to be obviously a short video. We again are seeing the S&P 500 climbing a wall of worry. We're seeing a rotation out of the tech area and NASDAQ stocks. Now, one of the things that I thought was going to happen this year is I thought that the 10% decline that we had in August was going to be a much bigger decline, 15, probably 20%. Instead, we turned right around and rallied back to new all-time highs. I think now what's going to happen is that once we get post-election and people start looking out to 2025, they're not going to be as positive. Companies' earnings are not going to be quite as good as what everybody expected. And I would not be surprised to see some type of healthy correction or pullback either at the end of the 2024 or going into 2025 as we sort out the U.S. economy heading forward. Again, Fed's cut short-term rates by 50 basis points. The question is going to be, are they going to cut by another 50 basis points in December? We've been getting some employment numbers, and although the employment numbers are softening up, they're not softening up as rapidly as what we think would entail another Fed 50 basis points rate cut. But stay tuned. The first of the month update is when we give you our view as far as what's coming up and what's been happening. Again, if you want to download my app by texting Chris E, C-H-R-I-S-E to 36260, you will see the slide deck on there. You will see our 20-minute Trade Talks roundtable, and obviously you see this video. That's all we have now for the October update. We'll be back soon. Take care, everybody.